Pandora in the context of other attractive tech investments. We're joined by Kevin Landis, president of First Hand Funds. His technology portfolio is beating out 99% of his peers, and he joins us now from San Jose. So, Kevin, first of all, what's your take on Pandora going out of the gate today, rising and then dropping back down to the beginning?
Well, my first impulse is to say the bankers priced it right. Hallelujah. I agree with your earlier guest. The job of the banker is to get the most proceeds that they can, or the fair market proceeds for the company, and it looks like they did that properly this time. Broadly speaking, though, stepping back, this is a great story. It's really uplifting.
Now, when you look at Pandora and another company, Groupon, planning to go public without any profits, does that concern you?
Well, I guess if I worked at Pandora, I would cringe that you just lumped me in with Groupon, because I think the stories are a little bit different. I think that Pandora's business model's pretty darn solid, and they're ramping. And if they continue to grow at the rate they're growing, they're going to be huge. And if the growth moderates to a more respectable but sustainable rate, they're probably going to turn around and become pretty cash flow positive, I think. So not making any money and saying that you'll never make any money are two very different things. And my understanding of the Pandora situation is that these guys are pretty close to cash flow break even, and at the rate they're growing and the customers they're adding, they should be fine.
All right, let's bring in Cory Johnson now into the conversation. Cory?
Kevin, uplifting, really? These guys are in Oakland, California. They're not in San Jose. Don't you feel like you need to be protecting the heart of Silicon Valley and keeping innovation down there?
You know, I guess for today, I'll spread my elbows a little bit and grab Oakland and bring it into the greater Silicon Valley. Actually, I'm a Berkeley guy, so Oakland is fine with me. You know, I just think it's great when a company sticks with it, and after 10 years, they finally get, you know, their due. And it's a great story of persistence, and it's a great story that you can still innovate, and you can still build something special and become a success.
Now, are you in this name in any way? Did you get any shares in the offering from your friends at Morgan Stanley?
No, we're not really IPO chasers. You know, I don't think we have the high velocity trading turnover to get to the front of the line anyway. So we're more of a buy and hold type shop. But no, we're not involved. We know one or two people who are, and we're very happy for them. But no, not involved in the name.
Now, one of the things that's interesting to me, and I talked about it in the drill down at the top of the show, is that the company really turned around when they got mobile, and when they got particularly on the iPhone and later on Android and other platforms. That business model, some would argue, is worse for them, because the user is not staring at a screen and seeing the ads. The CPMs, the cost per million, cost per thousand that advertisers pay is less in mobile. Do you see this when you see companies going into the world of mobile, that the advertising models don't work?
I don't know. I think you can ask the guys at Netflix. They were thrilled when the iPhone and the iPad came out, and the Netflix app was really turbocharged not only their subscription growth, but their transition from discs through the mail to streaming discs. So it worked very well for them. And you know, this is another great story. Silicon Valley builds innovation on top of other innovation. So it takes the iPhone and the Android platform to then bring out more success stories. And this is kind of the turbocharging effect that, you know, we used to take for granted, and frankly, it's been missing for a little while.
Kevin, you lived through the last bubble and may have lost a little bit of money there. How do you think what's happening today compares to that?
You know, this has some of the same human nature elements of it. You know, everybody wants X, therefore everyone chases X. Therefore, if you chase it, you run the risk of being the greater fool. That said, people are still awfully skeptical of established technology companies, and I was just talking to someone the other day running the price-earnings multiples on even very successful tech companies like Apple, and finding that they're very, very low. So, you know, it's not a euphoria, but there's definitely a flavor of technology companies that people are excited about and seem to have to buy. And I hope they don't chase them too hard, because you could get a mini bubble here if people are just convinced that they have to own the next Facebook, or they have to own Facebook.
So how do investors in this environment find the next good, sound tech investment?
This is the dilemma, because the tech names that are really familiar to you, that you could just sort of rattle off, Cisco, Intel, Microsoft, Applied Materials, they've been around enough that they've already pretty much captured whatever markets they were originally targeting, and they're struggling to find growth. So if you look at them like a Dow stock, they seem fine, but really a lot of people view them as kind of stale. On the other hand, if you look for what's new, well, by the time something that's new is anointed and is making headlines, well, then it's already really pricey. So unfortunately, what you really have to do is roll up your sleeves and kind of look in the cracks. Now, let me just point out,
all right,
Netflix is a good example. Publicly traded for a number of years, misunderstood, great story. You can find stocks like that.
All right, Kevin Landis, we'll have to leave it there. From First Hand Funds, thanks so much for your insights on the current environment.